Good afternoon, folks. My name is Mahmood from a very rain-sodden, miserable Leicester. A question I often get asked in my business from clients is about whether they should buy their company car, whether they should buy their car through their business. My session today, newly moved time of midday compared to 10:30, is to look at the whole regime about company cars. So let's just sit here. So focus today, and what we're going to get out of the session here, I'm going to look and explain to you about company cars, not just the numbers part, by the way, and about how tax works, but the bigger picture as part of what I would call a strategy for the company. We'll throw in some numbers. It wouldn't be a show without actually putting some numbers in there. We're going to give you some tips. I'm going to give you some tips of advice as we go through the session, and then we're going to look at the options for how you should buy that car. Before we launch into the broadcast, before we go through the wonderful things that you're going to get some value from and some benefit, just a few housekeeping exercises, if that's the right term. If you're live and listening in, thank you very much for giving up some of your valuable time on this very miserable day. Those rain clouds outside, unless you're listening from abroad in some wonderful Caribbean island. If you're not listening live directly, I'll forgive you all. If you're listening on #replay, I believe that's the magic words, put a comment in the box. I'll know you're there. I can say hello. And if you've got any questions that come through during the broadcast or afterwards, I will be able to address and answer them. This is very much what I call an interactive session. So obviously, if you're coming in, I'm here for you. So if there are questions that you've got, please, by all means, answer those questions. I'll answer them the best I can. If there's any follow-up that needs to be done, I'm sure we can do that. I'm very honoured and privileged that I've got one of my friends and business colleague partner. Good morning, Joe, to you. Joe is, you probably recognise, we do a broadcast on the Tuesday. Today is going to be fundamentally about company cars and tax. Now, I said but the purpose of this broadcast is not just to talk about the calculations. So if you've got access to Mr. Google, if you've got some time and inclination, working out the tax issues that involve with company cars, which can be quite complex, is the easier, certainly for me, the easier part of the calculation is about how it fits in with the whole schematic of your business. Now, in my business, I am an accountant. That's one of the hats that I wear. I've been running my own business for about 25 plus years, and my primary mission in my businesses is to help business owners develop sustainable businesses, strengthen and improve their money mindset, a really critical aspect of a business process, make profit. Let's not run away from that idea that business is there to make a profit. Whatever type of business you are, you need to make a profit, save time, save tax, and actually enjoy the life that they deserve to live. So let's crack on with the broadcast. So what I'm going to do here is a combination of a bit of slideshow. This will not be a death by PowerPoint session, I will promise you. We're going to go through some key points here. So that's about the company car tax regime, how it works, some updates in terms of how it's changed for the current year that we're in at the moment, some numbers just to illustrate the impact on that company car tax regime and whether you should or you shouldn't ultimately buy your car through your business. That's really the nub of the broadcast. We'll do some illustrations. I'll share some tips and advice, and in terms of what do we do next. I'll apologise by the way, all the graphics are mine. I create the graphics on this presentation, so they're rubbish. Then my apologies here. My business is not as designed. My business is to share some good information with you. So let's crack on with the broadcast. Now, if this works, which I hope it will, we're going to have in parallel. There we go. Nice little ticker tape straight from Broadcasting House at the bottom. That's as much to remind me what we're going to talk about. Now, it's important for me, I think, to start off with what's this idea when we talk about company cars. And I'm just going to spend a few moments now explaining what we mean by actually what is a company car. Now, what this means by nature is we're not talking about vans, we're not talking about motorbikes, we're not talking about push bikes, which all of those things that your company can provide for you. And by company, we're typically talking a limited company, not a self-employed business. So a car, in terms of the context we're talking about, is a car that's provided through which you as the driver will get some personal benefit out of the vehicle. Now, a personal benefit means that you could literally just work very long hours, and all the car is provided by your company is for driving between work and home. Well, that's considered private mileage, because commuting between your home and your office is typically ordinary commuting, and it's therefore classified as personal use. So you've got a company car there. It doesn't mean what's called a pool car. So if you've got a car as your business and you make it available for everybody, it's not really for a particular individual's use. It's available for everybody for business use. It's kept typically at your workplace. That's a pool car, and that doesn't apply in the session that we're looking at today. So we're talking about company cars, and a car is predominantly designed for carrying passengers. It's not for carrying goods or such as a van. So if a car is provided for an individual personal use, then you've got a company car on your hands. Morning, Nadine. Nadine is, I'm just going to sort of intersperse this by those welcoming people. So if you've given up your time to come and listen to this broadcast, I think it's only due courtesy that I say hello back. Obviously, I'm just going to bask in this little bit of glory here. Nadine, friend and client of mine here, loving that screen. Thank you very much, Nadine. Not a bad little piece of artwork, if I do say so myself. But any designers out there, I do apologise in advance. So we talk about what a car is. And in terms of what we're looking about here, before we talk about how we do the numbers and the tax impact, this, for me, when we look at things like car benefits, is part of a wider, what I call remuneration strategy. So as a business owner, you're there to make money, you're there to make profits, but you need to reward yourself as well. Typically, we reward ourselves, we pay ourselves through the provision of a salary. The salary goes through our what's called our PAYE system. And typically we receive a wage slip showing how much money that we're earning. The second main way that business owners will reward themselves is by payment and distribution of a dividend. The third route, one that I think tends to be underexplored, is by provision of certain benefits. And the benefits that we're providing, talking about today, is the car benefit. And the reason I say that I look at this as part of a wider strategy, even though your business is you, effectively you run it, you own it, you control it, outside of that company, outside that legal edifice, that legal structure, you have got your own personal lifestyle, hopefully. So you've got, your own house, you're going out, you're buying food, you're driving a vehicle. And what it means is, though, if you look at it collectively, sometimes it's better if your limited company provides some of those things to you to save you having to use your personal savings, money out of your own personal account. And therefore, overall, there is a benefit if you look at them collectively. And for me, certainly when I look at a tax strategy, certainly when I look at a remuneration strategy, I tend to look at the owners and the company combined. For those of you who might be listening, by the way, that might have companies that are not limited by shares, you may have limited by guarantee companies, so social enterprise typically, then this regime, what we're discussing, is still applicable. So in this context here, let's look at the next thing. So having decided what a car is, so it's a vehicle that's predominantly designed to carry people. You typically, as the individual driver, it's for your exclusive use, even though it's owned by the company. You're using it for private purposes. The next thing, when that happens, you trigger then what's called a benefit charge. Now, the benefit charge is seen as a value to convert the car that's been provided. We have to work out an equivalent value because HMRC see a car benefit, like many other benefits that are taxable, as equivalent to paying salary to an individual. So what we need to do, we need to take the car, we need to then figure out what's the equivalent financial value of that benefit, because once we've worked out the financial benefit of that value, we can then work out what the tax implications are for the individual and what the tax implications are for the company. So working out that benefit value is really quite key. And we're going to explore that in a few moments and look at a bit more detail as to how we work out that benefit value. Having worked out the benefit value, there are implications both for the business, which is the company, which is separate from you as the individual, and there's the implications for you as the individual. So if you have your own company, if you are the shareholder director of that company, typically what will happen is any income that goes to you, any value that goes to you as an individual is going to be taxed under what's called income tax rules. Typically, anything that the company generates will be taxed under a different set of rules, corporation tax rules. So they are, in legal terms and tax terms, two separate entities. As a heads up, as an individual, you typically will pay income tax on the value of that benefit. How much that will be, I'll explain later on. I don't want to overawe us with numbers at this stage. And the implications of the company, by the way, will be potentially a tax saving in terms of reducing its company tax bill, but also it will pay what's called employers' national insurance on the provision of that benefit. Now, you may have observed that I have not actually mentioned what's called employees' national insurance. One of the upsides, one of the big advantages of providing benefits to individuals such as you as the owner or your employees or your staff is that you avoid paying employees' national insurance on that benefit. So if you were paid a conventional salary, there is employees' national insurance that will be accruing on that. If you provide a benefit, employees, not employers, employees' national insurance is avoided. And that is one of the reasons why benefits in kind are potentially quite a favourable way to remunerate and reward yourself as the business owner. Let's move on. Now I'm just going to try and coordinate here the slides and the banners. I'm not quite whizzy tech with all the controls as such yet, so if you just bear with this very old-fashioned way of showing it on here. So let's have a look in terms of how we work out the value of the benefit. Now, as a upside or heads up, I should say, if I could speak, is the value of the benefit is generally speaking calculated by working out the manufacturer's list price, multiplying it by what's called a relevant or appropriate percentage, and that percentage that you apply is dependent on what type of vehicle you have in terms of the fuel supply, the power supply to power that vehicle. The whole objective of the company car tax regime as we have it in the UK is to encourage businesses to go green, effectively to purchase vehicles which have a very low emission of CO2. So let me recap. Number one, first of all, the list price. What does that consist of? Now, be very careful. The list price is not the cost of you actually buying that car. So a lot of dealerships will have special offers on their vehicles. The price you actually pay for the vehicle is not the number we're interested in. The figure we're interested in is what's the manufacturer's list price of the vehicle. The actual physical price you pay for it is an irrelevance for when it comes to working out the company car tax implications. Now, HMRC have said that when you want list price of vehicles, there's a publication called Glass's Guide, which is used by people who are involved in the motor trade. It's their Bible, so to speak. And the Glass's Guide, or the original manufacturer, will be able to give you what's called the list price of the vehicle. The list price of the vehicle will be inclusive of VAT. The list price of the vehicle will be after any personal contributions made by the employee towards that vehicle. So typically, if I was going to buy a car where the manufacturer's list price was say 30 grand, and it was advantageous for me as the business owner or the employee to contribute towards that vehicle purchase, maybe because I can get a different model perhaps, or because there's a tax saving, then that is knocked off the list price. The list price is also inclusive of any accessories that are fitted to the vehicle. There is no upper limit, by the way. So if you have a budget that you can go out and buy a Porsche sports car retailing at around about £85,000, that's fair. Now, the next thing is we've got the list price of the vehicle. It includes VAT. We take into account any personal contribution made by you or one of your team, one of your employees. We then have to multiply that by a percentage. And the percentage is based on the CO2 emissions of the vehicle. Now, the CO2 emissions of the vehicle will range. And the lowest rate will be if you've got a vehicle that's electrically powered, the CO2 emissions are 0. If you've got a hybrid vehicle, then the CO2 emissions that, as recognised by HMRC, will fluctuate from 0 upwards to a percentage equivalent of 37%. Now, a couple of things worthy of note here. On the next slide, when we talk about electric vehicles and what I call hybrid vehicles, they are ones that attract a much more favourable tax treatment because the emissions they have in terms of CO2 is quite low, and those low CO2 emissions will generate an appropriate percentage. The maximum percentage, by the way, you will have for a vehicle, which is very high emissions, typically up to 170 grams per kilometre of CO2, will be 37%. So if you buy a vehicle that's very high emissions of CO2, typically around about 170 grams plus per kilometre of CO2, then your percentage that you'll be applying is 37. One more thing to take into account. Diesel vehicles are considered very bad for the environment. Diesel vehicles carry a 4% supplement on the published percentage rates. Now let's move on to see how that manifests itself. What I'm going to talk about now is, as a heads up, if you've got an electric or a hybrid vehicle, they're very low in CO2 emissions, generally speaking, and the percentage charge appropriately is quite low or quite small. If you've got a vehicle that's not a hybrid, not electric vehicle, and it has high emissions of CO2, then you have a higher percentage, which gives you a higher benefit value. Let's move on to the number 3. Now, I'm particularly looking at electric and hybrid vehicles and the regime that's in existence for 6th of April 2020 onwards. And the figures that I'm going to be quoting subsequently will be for cars that are registered from the 6th of April 2020 onwards. Now, if you have an electric vehicle, i.e. there is 0 emissions of CO2 because there's no alternative fuel supply, then the emissions are 0. The relevant percentage is 0, so irrespective of the purchase price of the vehicle, the assessable benefit, have a guess, will be 0. What that would mean is that on that basis, there is no benefit in kind value assessed on the individual employee. If you buy your car through the business and it's an electric car, then there is no benefit charged to you as an individual owner. And also, there are some favourable tax treatments for the company as well. And the company can claim that purchase as an allowable business cost in full. If, however, your vehicle is what's called a hybrid, so typically that will have an alternative fuel supply, so it'll be part electric, part diesel, perhaps part petrol, then what happens is the percentage you apply will be based on the range of the vehicle with a single electric charge. Now, I've decided not to deliberately publish all 11 to plus bands there are, but suffice it to say, the bigger the range on a single electric charge your vehicle has, the lower the percentage. The smaller the range on a single electric charge your vehicle has is, then the higher the percentage. Now, I haven't quite memorized all these, so typically, if you've got a hybrid vehicle that can do no more than, say, 30 miles on a single electric charge, then your percentage will be 12%. If your vehicle is a hybrid and the electric range is much better, then effectively anything over 70 to 129 is going to be 3%. So those are good numbers. Anything up to 50, by the way, over 130 miles on a single charge, then it's a 0 charge. Now, when I first talked about electric cars, when I first started talking about company cars many years ago, certainly in the last few years, what I've noticed is many more manufacturers are getting on the game. The quality of electric vehicles are far more impressive nowadays than they were several years ago. Also, the range of the vehicles is much better than it was a few years ago. And there's an added bonus as well, by the way. And that added bonus is that if you decide you want to go out and purchase an electric car, you are entitled to a grant of up to £3,000 towards that purchase. It's typically dealt with by the dealership. And also, you can access a grant of up to £350 that goes towards any charging units. There are a few more benefits, by the way, for electric cars, which I'll mention towards the end of the session. But effectively, what we're talking about here, the whole regime is structured now to encourage businesses to purchase low-emitting carbon dioxide, ideally zero, to punish those drivers, to punish those businesses that purchase high-emitting CO2 vehicles. And that includes diesel, which has got a higher supplement to it. In addition, what you'll find is that there's an incentive. There are more charging units being developed. There are more places that you can recharge a vehicle. Obviously, you can recharge your vehicles at home. So definitely we are seeing a growth in the infrastructure and the charging units. And there's a big push now towards the CO2 being reduced as much as possible through vehicles. Approximately last time I looked, by the way, just a slight diversion, there are 1 million plus car owners in the UK. And I would envisage from what I've seen that the proportion of people buying electric cars will increase as time goes on. So again, very much we've got a situation where hybrid and electric is a definite thumbs up, both in terms of the cost of providing the vehicle to you as the owner or to your staff, and also the tax treatments on it accordingly. Now, we've talked about tax. I've deliberately kept the numbers quite minimal because I want us to be aware of the overview, the framework of how the system works. Now, let's throw some numbers into the equation because it wouldn't be a presentation on numbers and tax unless we had some. So by the power of magic, let's go on to the next slide. Now, the tax, as I commented at the beginning of the session, falls in two ways. There's the impact on you as the business owner and or your staff if you're providing a car to them. And also there's the impact on tax for your business, for your company. Collectively, when I develop a strategy, I tend to look at the two together to see what's the most advantageous overall. But effectively, what we're looking at here is we're going to look at them in isolation, but certainly I would blend them together to see what the impact is. Now, tax implications. We said at the very beginning that when we work out the tax impact on the individual, i.e. you as the business owner or your staff, we look at the value of the benefit provided, and we then take into account what the tax status of that individual is. So if you are what's called a basic rate taxpayer, i.e. your total income is below £50,000, then you are a basic rate taxpayer and you pay 20% on your income. And your car benefit is seen as part of your income. If you are mid-tier, between £50,000 worth of income, typically salaries, any part-time self-employment you might have, any rental income that you've got, effectively any other additional income that you may enjoy. When the combined value is between 50 and 150,000, you are called a higher rate taxpayer. And a higher rate taxpayer would pay tax at 40% on their income. If you're in that situation where you've got a high income over 150,000, then you are what's called an additional rate payer and you pay tax at 45% on income in that band. So the tax that you pay as an individual is influenced by your income position. It's either basic rates, it's either higher rates, or it might be an additional rate payer. Now, as far as the company is concerned, the tax implications are threefold. Number one, once we've worked out the value of that benefit, typically list price times relevant percentage, and the relevant percentage is predicated and determined by the CO2 emissions. That value, the employer, which is your business, will pay employers' national insurance on the value of that benefit. And the employer's national insurance is currently 13.8%, 14% if you want to round it up in new money. So if you've got £1,000 benefit, that's the value, then the company, your business, will pay 13.8% of that over to HMRC. The one thing that's not deductible from that taxable benefit is employees' national insurance. That's number one. Number two, for having purchased the car, the company, your business, is allowed to make a claim for what are called capital allowances on that vehicle. And those capital allowances, again, will be determined by the CO2 emissions on the vehicle. It goes from 100% allowable cost up to a miserly 6% deduction. And the tax saving will be in corporation tax. So effectively, the purchase of the car will give you some tax savings. Also, by the way, any costs of running the vehicle are fully deductible against your business profits. The other implication for tax is that national insurance that's paid out will also save the company, your business, in some corporation tax as well. So that's the three things that we need to blend together. You've got the benefit value provided, you've got an employer's national insurance cost, you've got a corporation tax saving on the employer's national insurance, and also a corporation tax saving on the cost of the purchase of the vehicle. And lastly, the cost of running the vehicle all come out of the company coffers, which is good news. And what that means is, if we look at that collectively, it doesn't come out of your own personal pocket. So for me, that's where the advantage actually comes in. That's your business, your company, it's paying for all of that you would normally pay for yourself. It comes out of the company coffers, all tax deductible, all perfectly fine as long as you structure it in the right manner. If you're just coming onto the replay as we are, as I said, hit hashtag replay. I'll see your comments and I'll pick these up accordingly. Now, it wouldn't be a presentation about numbers and tax unless we had some illustrations. And that's the next thing I want to show you, is what the implications are. And I'm going to compare and contrast electric and hybrid cars against a fossil fuel provided vehicle. Let's bring this up. Now, hopefully the colours come across okay. In my bid to try and be creative here, the colours might be a bit painful in the eyes, but hopefully they are legible. Now, at the top, apologies for the old tax speak here, what I've done is to summarise the three types of tax position you as a taxpayer will have. So you'll either be a basic rate taxpayer, that's where your total income from salaries, self-employment, say rented property, is up to £50,000 in a tax year. You've also got a high rate taxpayer where it's between 50 and 150. And you've got an additional payer that's £150,000 a year plus. Now let's assume that the company car has cost you £30,000. Well, if that company car has cost you £30,000, if it's an electric vehicle where the emissions are zero, or it's a hybrid vehicle which can effectively run on a single electric charge up to 130 miles, then there is a zero benefit percentage, which means the value of that benefit provided to you is surprisingly zero. The personal tax cost to you is zero, and the cost to the company for making a £30,000 purchase is £24,300. And the reason that would be is because the company, if it purchases an electric or hybrid vehicle that can run up to 130 miles, is able to claim the cost of the vehicle in its entirety. So as a single one-off cost, it can deduct that against its company profits. So that's the net cost to the company of that purchase. Now let's contrast what it would be if we went to purchase a vehicle that's not electric. The hybrid it doesn't apply, so it's conventional fossil fuel, petrol, brackets, diesel. So let's bring this up. Now, the values are the same. So we're talking about a car that is costing £30,000, inclusive of VAT, inclusive of fitted accessories. Now, the equivalent I've given for a petrol vehicle, pretty much a standard average, that emits between 105 and 109 grams per kilometre of CO2. Now, if you look at it, the cost of the company is not as small compared to the electric or hybrid vehicle. The cost is 29,779. Just as I give you a heads up as to how I've arrived at those numbers, that takes into account the employer's national insurance that's paid over by the company. It takes into account the tax savings on that, and it takes into account the tax savings on the allowances. At that range, the allowances are much smaller, and therefore the net cost is not going to be as significantly lower. The benefit percentage is 24% on that emission. What that means is, for a taxpayer, the value of the benefit is 7,200, and that's the tax implication for you as the owner of what your extra tax bill will be, going from 1,440 up to 2,880 as a higher rate taxpayer, and £3,240 if you're additional. Now, it doesn't mean you shouldn't do it, by the way. The way I would always look at these things is to say, what would it cost you as an individual to go out and buy the car personally, to obtain the vehicle personally? It's an option I'm going to explore in the last couple of slides. So therefore, you need to do a weighing up exercise. Now, we're just coming up towards the end of the broadcast, and I'm just going to go and talk about options. And I'm going to mention also and throw in a couple of tax tips to take into account before we draw the show to a conclusion. Okay, here we go. Now, here's the options typically available to you as the owner and or your staff if you want to provide a car to the individual. Now, number one, you can make a car allowance available. So as part of your salary package to yourself or a salary package to your employees, you add in a car allowance. Car allowances are taxable. So just seen as an extension of your salary. You as the owner, you as the driver of that vehicle, or your staff, if you're using it for business purposes, you can claim back a mileage rate of 45 pence per mile for using that vehicle. So in other words, you're getting an extra allowance there that goes towards the purchase of the car. It's taxable on the individual, and it's taxable and NIable for employers' national insurance by the company. However, when you're using that vehicle, it's yours, you own it as the actual driver, and you just charge your business 45 pence a mile up to 10,000 miles for using it. You are responsible, though, for the maintenance of that vehicle. It's not a company obligation. So it's an option. Number two, you as the business owner, you get your business, your company, to actually go out and purchase that vehicle outright. Now, generally speaking, you've got two options here. You either use cash if you've got that level of cash in your business to go out and buy it outright. You can either borrow money from a bank or an institution to go out and buy the vehicle, or you acquire that vehicle on hire purchase. Now, if you acquire the vehicle on hire purchase, you can claim all the allowances on that vehicle. So obviously that's going to be much better for you cash flow wise. You can claim all the vehicle costs. The other option is what's called leasing, and leasing is slightly different to hire purchase. And on leasing, typically, let's assume a leasing agreement that is typically over 45 days, then you have a restriction on what you can claim back on that vehicle. It is an option nevertheless, but it's still restricted. But it also means that you can recover some of the VAT on that vehicle purchase. Now, let me just share a couple of tax tips for you as well. I said at the beginning of the session that you as the owner, you as the employee, can contribute towards the purchase of that vehicle. And that's perfectly true. It may be, if you do that, you will find, if it's a high emitting vehicle in terms of CO2, that contributing towards the actual purchase cost of the vehicle reduces the assessable benefit, and therefore it reduces the tax that you pay as an individual and what the business also pays on employees' NIC. And the other thing I would strongly suggest is sometimes is advantageous for you to make a personal contribution towards the value of the benefit that's assessed. So whether that's a good thing or a bad thing depends on lots of variables, like your status as a taxpayer. It depends on the type of vehicle that you're procuring, but it's definitely something that's worth exploring. So folks, I hope you found this presentation useful. And so let's just summarize what the main bits that we've said. The main things to come out of this as well is that when you want to think about buying a car for your business, definitely have a look at an electric vehicle or a hybrid vehicle. Okay, they are certainly the most tax advantageous for you as the owner and for you as the individual who may have some exposure to personal tax. Number two, there are options as to how you buy that vehicle. So hire purchasing, leasing typically are more favoured. The cash flow is much more favourable, less restrictive. Thirdly, you need to blend this in as part of an overall remuneration strategy. Don't look at it in isolation, but rewarding yourself, this could be a great way of actually doing it. Again, I hope you found it useful. Again, if you're coming up on replay, hit #replay, add in any comments. We've got plenty of resources to share with you on our website. Let me just do a little plug there. It comes through here. So if you want to find out more information, just visit the website on proactiveresolutions.com. You can, by all means, I'm happy for you to DM if you want to join our mailing list. We have clients on our mailing list, but we have non-clients as well. We don't stalk them. We don't hassle them. We just share regular podcasts, news articles. So with that in mind, everyone, have a fantastic rest of the week, and I'll see you same time next week, next midday. Ciao. Nadine, my pleasure. Have a good week, and I look forward to your broadcasts as well. Take care.